You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
And welcome back to the Options Insider Network. This is Mark Sebastian coming to you live from the CBOE Risk Management Conference. I'm joined by Ben Londergan, who is an Executive Management Director at Convergex Group. And I believe he's in charge of the Options Execution Division.
That's right, Mark. It's nice to be here. Thank you for having me.
Hey, it's great. So, we just got done listening to Andy Nybo at Tab Group talk about liquidity. And, one of the real things that on that panel was about brokerage execution and the exchanges. So talk to us about, the landscape of the exchange place in and of itself. So the fact that there's 13 exchanges, potentially 15, what effect is that having on the overall marketplace?
Well, certainly when you have more venues for liquidity providers to provide liquidity on, you tend to see fragmentation of liquidity, which tends to create a more difficult overall environment in terms of finding liquidity, sourcing liquidity, and being able to execute trades. In addition, I would note that you're also seeing more trades going up in auctions, and you're seeing wider bid-ask spreads in the options themselves. And so as you see those things, what you're really starting to see is more exchanges plus wider quotes plus more internalization equals, I would say, just a much more difficult environment in terms of finding and sourcing liquidity.
Yeah, so how does a firm like Liquid Point, or Convergex Group, formerly Liquid Point, how do you navigate that landscape for your customers? Best execution is such a wide term, so, and open to interpretation. How do you guys manage that process and really do what's best for your customer?
So we're a little bit unique, and I'll speak to us specifically, and then I can speak to kind of more generally speaking how do broker-dealers navigate this as a whole. So for us, one of the interesting things is that we actually run an ATS called NXP that allows...
ATS?
Yes, an options ATS. So we basically allow...
Why don't you tell what does an ATS stand for?
Alternative trading system. So we basically allow options orders to potentially pair and get price improved before they go to the exchanges. And so at some point in time, we actually give people some opportunity to go into auction before they before they just hit the NBBO. And then other than that, we have a whole suite of internally based logic and algos that people can use to try and access and source liquidity. So that's kind of Convergex and how we approach the problem. And obviously, there's it's a very difficult question because there's a lot of stuff you're going to want to do on the front end in terms of trying to make sure that you're, using the correct algo and going to the correct places. And on the back end, you're going to want to make sure you're doing monitoring of fills and making sure that you're, that what you expect going in is what you expect is what you get back coming out, and looking at if you start to see differentials, trying to figure out why that's the case, and obviously tweaking as needed. From a more general perspective, it is a very it's a difficult environment just because at some point in time you really are having to manage a lot more exchanges, a lot more fragmentation of liquidity, and again, it just makes it for a difficult environment. When you combine that with, for example, if you are routing to an auction, how do you measure then? How do you even measure best X when 50% of the paper is getting auctioned? How do you know when the options exchanges aren't even releasing auction statistics publicly? How do you know which exchange has the best auction, for example? And how do you even define best auction? Is best auction defined as best overall price, or is it defined as the most number of times that you see price improvement at all? And again, there's just a whole host of new variables that have really been introduced. They've been around for a long time, but they've really only become major aspects of the market in the last 12 to 18 months.
You're also the former CEO of a market-making firm. How do you think that this change in landscape and all these exchanges is affecting the other side of the business, the liquidity provider?
My feeling from looking at the widening of the spreads is that as you see more flow get auctioned, there's less and less incentive for market makers to be at the top of market. And then overall, I think that's a huge negative for the options marketplace as a whole. In addition, look, I think it's just bad for the market makers in general. I mean, the vast majority of marketplaces that offer an auction actually have some kind of, I'll use the term breakup fee, or some kind of incentive for the person who actually brings the auction in. And so at some point in time, all these things make it more expensive for the market maker who doesn't have order flow to compete. And so I think all those things are negative for the market makers, and in addition, negative for the marketplace. All of those comments effectively, buy into the concept that the displayed liquidity in the U.S. equity options marketplace has been one of the big drivers for kind of customer satisfaction. That, hey, I can see where I can get in, I can see where I can get out. Markets are relatively tight and relatively liquid. I believe that, and I'm a little bit afraid that based on what I've seen over the last 12 months that we're starting to move kind of more away from that model. The good news is I think there are some relatively straightforward, quote-unquote fixes to that issue. So.
Okay, and that's an interesting point. We've been talking about the rumored death of the floors have been around for years. We're listening to the CMEs getting rid of their futures guys, and at the same time you've got the CBOE actually doubling down on its floor with this Russell deal and some of these different indexes. Where do you see kind of floors going, and do you really think that 5 years from now we're going to be talking about the CBOE doesn't have a floor anymore, CME doesn't have a floor anymore? Where do you think things are actually going from that concept, and does floor trading still have a place in this in the world, if you will?
It's a great question. My viewpoint is that there is a real service that the floor and the floor brokers provide. And what I would say is that's really primarily price discovery and price exposure for large size trades. There are theoretically ways to automate that. A lot of people have tried to automate that and have failed. I think CBOE has a very good model, and certainly can understand why they're looking to expand that model. To be honest with you, CME, I'm just not as familiar with their plan to get rid of the floor, but looking at one of their kind of key floor products, Eurodollar options, that's been available electronically for years, and the percentage of flow, at least the last time I looked, that was trading electronically was still quite low, and it's a difficult product. So I don't know. They may have a plan that I'm not aware of to really revamp and push that more electronically, but that's a little hard for me to believe based on what I've seen.
I'm trying to figure out how. I mean, those guys do. If people that are familiar with SPX, where there'll be 4 ways. I mean, those guys will trade like 9 ways. It's hard for me to fathom how you do that electronically. The
other thing I'd say, right, is part of it is really the direction that people want to and when I say people, I mean the marketplace as a whole wants to go, right? Like, in my opinion, exposure is always good for an order, very generally speaking. But so if someone brings in a crossed order, exposing it to other market participants for potential price improvement, theoretically is generally speaking not a bad thing. And that's what I have seen from my personal interactions with the CBOE floor, is that you have large institutional size trades going up in their proprietary products, and I think it's a benefit that the market makers who stand on the floor have the ability to potentially price improve those orders. That being said, that doesn't necessarily have to be where things go, and to the extent people wanted to move towards a more, and I'll just use air quotes here, European model, where people are okay with just having large institutional originator versus large institutional counterparty, just have counterparty to counterparty trading. So that's certainly, if that's where the regulators wanted to go and where the exchanges wanted to go, it would be easier, I think, to ultimately get rid of the floors. I don't believe at all that that's the better model in the long run, but it's possible.
Moving back to the discussion that we heard, one of the things that was interesting is, when you get out of the high frequency space, customers are actually more interested in getting customer service as much as they are actually getting great rates. Describe how, and yet a lot of the small and mid-tier, hedge funds and money managers are unable to access high-touch services and things like that. So describe how, is there a way for the small to mid-sized firm to navigate their way to getting better options execution service than having to go through just some, random front end and electronically see their trades disappear?
Absolutely. I mean, again, a lot of this is having the hedge fund deal with the person who's handling their order flow, and ultimately demanding, hey, I want this to be exposed to high touch. Certainly, an easy answer is call Convergex. But from a broader perspective, I think it's fair to say that, I certainly look. There are benefits to being able to access the market electronically, quickly, and there are benefits to having high touch services, right? And certain customers want either one, and to the extent that there are small hedge funds who really want to have high touch service, I think that makes a lot of sense. Now, look, it's the high touch desks themselves aren't going to want to take a 10 lot, right? I mean, it's just not, that doesn't make sense for anybody. So if there was a hedge fund that's trading 10 lots and is like, I really think I would benefit from high touch, that's probably not going to happen. But, if you're a high touch, you're a hedge fund that's, trading 1,000 lots, but you're only trading 2,000 lots per month just because you're just getting started, certainly, I mean, there's no reason why you wouldn't want to be able to demand, hey, I'd like to have this order, go through high touch to try and find price improvement or have a higher level of customer service or whatever it is that you're looking to use high touch for.
Okay. Well, Ben, any other kind of closing thoughts on kind of the discussion we've had? Otherwise, I'll let you go and get back to schmoozing. And
I would just say it's been great to see you. It's great to be out here in California. Definitely the options landscape has gotten significantly more complicated over the last 12 months, and it'll be really interesting to see where things go in terms of, are there any regulatory changes, or do the exchanges change their rule structures to try and incentivize more quoting? The exchanges appear to be cognizant of the fact that they're losing quoting and quoters, and or that spreads are widening, and I think at this point I haven't heard anybody really pounding the table in terms of saying this is horrible or this is not bad or this is wonderful. So I think we're going to need some thought leadership and some someone to step up and kind of drive the bus, for lack of a better way to say it, in terms of figuring out exactly how, as an industry, we want to respond to kind of what's happening now. So it'll be very interesting to see how that shapes up over the next 6 months.
So do you think that, this just brings a question to my head. What's it going to take to basically reverse the expansion of exchanges? I mean, is it going to have to be a rule change, you think?
Well, in terms of expansion of exchanges, I don't think you will see that reverse until economically it becomes unviable, basically, to launch an exchange. We're certainly not there yet. The other thing, right, is a lot of the expansion has been what I would call kind of pseudo expansion. So, already established exchanges say, wait a minute, I already have all this technology. Why don't I just launch a second exchange or a third exchange because I want to have an extra model or an extra medallion? Mm-hmm. I think I think there's a limit to that. I don't think you'll see that expanding much. My guess is you'll see another 2 to 3 exchanges in the next two years maybe. But I think there's also the potential for consolidation. The thing I'm more concerned about is really, so you've got the one issue, which is fragmentation of the marketplace, generally speaking, I think not wonderful. And you've got the second issue, which is the widening of the quoted spread and potentially decrease of displayed liquidity. Those things I think are both arguably worse than fragmentation. So I'm really interested to see who's going to step up and say, hey, wait a minute, in order to respond to the auctions, for example, you have to be on the quoted market. I'm not arguing that that's the right or wrong response, but again,
but you can see a rule like that coming.
Yes, absolutely. I mean, I think at some point in time, you have to create some incentive for people to be there on the quoted markets. Otherwise, you're going to continue to see a widening of quotes and a decrease in displayed liquidity, both of which I argue are bad for the marketplace.
All right. Well, Ben, I really appreciate your time. Thanks for joining us. And we'll be back with more on the Options Insider Radio Network.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.